Well, on November 13th, the IRS just dropped the new contribution limits for the year 2026 for all types of retirement accounts, as well as things like HSAs and other types of accounts. So in this video, I want to go over the new contribution limits for IRAs and some of their new rules, the 401k contribution limits that will be into effect in 2026, HSA limits, and some of the new rules due to the Secure 2.0 Act that was actually passed a few years ago, but there's some provisions that actually take place or start next year. And then I'll talk about the new Savers Credit Limits. So I won't waste your time. Let's get right into it. All right, IRA and Roth IRA contribution limits. For 2025, anybody under the age of 50 can contribute $7,000. In 2026, that goes up to $7,500. Now, if you're 50 and older in 2025, you could contribute an additional $1,000 over the 7, so a total of 8. In 2026, if you're 50 and older, you can contribute an additional $1,100, making a total of $8,600 for your contribution. A few things to keep in mind. You can contribute to both types of IRA. However, the combined contribution of the two still cannot exceed these limits. You have until April 15th to make that contribution. For example, for the year 2025, you actually have until April 15th of 2026 to continue putting in money for the year 2025. Naturally, the sooner you put it in, the longer your money has to work. Generally, that's better. Now, you can't contribute more to an IRA than you have earned, though. Okay, these are the limits, but let's say this might apply to maybe like a college student. Maybe they only work in the summer. Let's say they make $5,000 total in 1 year. Then their limit is $5,000. But generally, for most people, these are the limits we would go by. There are phase-out limits that apply to both types of IRAs, which I'll talk about in just a moment. Okay. However, if you nor your spouse is covered by a retirement plan at work, the traditional IRA contribution is fully deductible regardless of your modified adjusted gross income. All right, so let's take a look at the phase-out periods that apply. So when you or your spouse is covered by a workplace retirement plan, then you have to worry about whether your contribution to a traditional IRA is going to be deductible. Regardless of income, you can always contribute to a traditional IRA. However, whether that contribution is deductible or not, okay, again, this applies to whether you or your spouse is covered by a workplace plan, is determined by these thresholds. So if you're single and covered by a workplace plan, okay, your contribution is fully deductible if you make less than $81,000. It starts to phase out, completely gone at $91,000. Married filing jointly, and you're the one covered, then your contribution will be fully deductible if you make less than $129,000. Starts to phase out and completely gone at $149,000. Married filing jointly, you are not covered, but your spouse is. Here's your thresholds. And then married filing separately, the penalties or the thresholds are very harsh here. This is when either spouse is covered. Starts phasing out right away and completely gone at $10,000. Okay, now, the modified adjusted gross income phase out ranges for a Roth. This determines whether you're even able to do the Roth. Okay, so single or head of household. If you make less than $153,000, you can contribute the full amount. Then it starts to phase out and completely gone at $168,000. Married filing jointly, we see our thresholds here. And married filing separately, again, very harsh thresholds. Now, if you're over those amounts, you would have to consider something like a backdoor Roth IRA. Let me take a quick moment here to say I sure appreciate it if you'd hit the like button, and I do hope you leave some comments below about what you think about these changes from the IRS. Okay, let's go ahead and continue. Let's take a look at the contribution limits for things like 401ks, 403bs, TSP plans, and most 457 plans. In 2025, if you're under the age of 50, you can contribute $23,500. In 2026, that goes up to $24,500, so a little over a 4% increase there. If you're 50 or older in 2025, you can contribute an extra $7,500. In 2026, that goes up to $8,000. Now, there is a super catch-up period. If you're between the ages, or if your age is 60 to 63, so for 4 years, you could do a catch-up contribution of $11,250. Now, that's not in addition to this catch-up, okay? It's just that during those years, this catch-up replaces this, okay? After 63, so for 64 and older, this would go back into effect. So that part does not change. Okay. Now, when you're looking at these limits, the employer match, if you're getting one, does not count towards the limits. This is only talking about what you're contributing. And the same limits apply to both a Roth and a traditional account. Combined limit, okay, so the amount that you put in and what the employer puts in cannot exceed $72,000 for the year 2026. And when you're looking at that limit there, the catch-up does not count. The deadline for contributions, okay, it's not April 15th like the IRA. Okay, all the money would have to be in by December 31st. There's no income limits for these types of retirement accounts. Okay, so high income earners, everybody qualifies for these if your employer offers them. And however, on the catch-up portion, there are some new rules for high income earners that you need to be aware of. Let's take a look at those. These apply to 401ks, 403bs, TSP, 457b. Okay, the contribution for high income earners on the catch-up portion must be made to a Roth account. Okay, so for 2026, participants, okay, it's based on your 2025 wages, no other income, just the wages. Wages of $145,000 adjusted for inflation, or $150,000 basically, or more, will be required to make the catch-up contribution portion, if you're doing that, to a Roth account, not a pre-taxed account. Okay, this rule applies to both normal catch-up contributions and the super catch-up contributions. So it's based on your wages of the previous year, so 2025, and what it means is if you meet that threshold, you must make the catch-up contribution to a Roth account. So even if you are doing, let's say, a traditional 401k account, and you're 50 and older and you want to do the catch-up bonus, the catch-up portion contribution would have to be made. You don't have a choice. You can't put it into the traditional. It would have to be made to a Roth account that your employer would have to offer, of course. Okay, now let's take a look at health savings accounts for 2026. Naturally, to qualify for an HSA, you have to have a high deductible health plan. If you're doing this by yourself, the maximum contribution in 2026 is $4,400. For a family, it's $8,750. To determine whether you qualify for a high deductible health plan, your minimum deductible has to be $1,700 for a single person and $3,400 for a family. Maximum out-of-pocket limit has to fall within these ranges. There is a catch-up contribution for those age 55 and older and not enrolled in Medicare. That's $1,000. If you and your spouse are both over 55, each of you can make that $1,000 contribution catch up, but it must be in separate HSAs. You cannot be claimed on anybody else's tax return as a dependent, of course. And the deadline is similar to an IRA. It's April 15th. Okay, so notice we've talked about a lot of different types of retirement accounts, and actually an HSA is a great retirement account if handled properly. But then we have the IRAs, both traditional and Roth. We have things like 401ks. And if you have your choice of several of these, you might be wondering, what's the best order to do things? There is generally an optimal order to invest. And if you're interested in really taking a closer look at that, I do have a video on that exact topic that I'll link in the description below if you're interested. So you might want to take a look at that. Now, the last thing I'll take a look at here is the 2026 Savers Credit Limits. This is free money if you qualify, so you really want to take a look at this. This is based on your adjusted gross income. These are the phase-out ranges. So what this is, it's really an incentive to get or help mid and low income taxpayers to contribute to a retirement account of some kind. Any type of retirement account qualifies. For example, IRAs or 401ks, okay? It's a credit on your tax bill. And a credit is better than a tax deduction because this is truly free money. A credit off of your federal income tax bill, up to $1,000 for individuals and $2,000 for married filing jointly. Any type of retirement account qualifies you. Rollovers do not qualify. Now, to determine whether you get this, head of household, if you're filing as head of household, if you make less than $36,375, you'd qualify for the full benefit. It phases out and completely gone at $60,375. Married filing jointly, you can see the thresholds there. And then all other filers, here's the threshold. So again, if you think you might qualify for something like this, you might want to talk to your tax professional and make sure that you're taking advantage of this because it really is a good deal for mid and low income earners. Okay, so I hope some of this information has been helpful. I hope you hit the like button, leave me some comments below, and thank you for watching.